Today, we will talk about Basel II, definition, purpose, regulatory reforms. Basel II is a set of international banking regulations first released in 2004 by the Basel Committee on Banking Supervision. It expanded the rules for minimum capital requirements established under Basel I, the first international regulatory accord, provided a framework for regulatory supervision and set new disclosure requirements for assessing the capital adequacy of banks. Basel II is the second of three Basel Accords. It is based on three main pillars: minimum capital requirements, regulatory supervision, and market discipline. Minimum capital requirements play the most important role in Basel II and obligate banks to maintain certain ratios of capital to their risk-weighted assets. Because banking regulations varied significantly among countries before the introduction of the Basel Accords, the unified framework of Basel I helped countries standardize their rules and alleviate market anxiety regarding risks in the banking system. Building on Basel I, Basel II provided guidelines for the calculation of minimum regulatory capital ratios and confirmed the requirement that banks maintain a capital reserve equal to at least 8% of their risk-weighted assets. Basel II divides the eligible regulatory capital of a bank into three tiers. The higher the tier, the more secure and liquid its assets. Regulatory supervision is the second pillar of Basel II and provides a framework for national regulatory bodies to deal with various types of risks, including systemic risk, liquidity risk, and legal risks. The market discipline pillar introduces various disclosure requirements for banks' risk exposures, risk assessment processes, and capital adequacy. On the plus side, Basel II clarified and expanded the regulations introduced by the original Basel I Accord. It also helped regulators begin to address some of the financial innovations and new financial products that had come along since Basel I's debut in 1988. However, Basel II was not entirely successful and even called a miserable failure in its central mission of making the financial world safer. The subprime mortgage meltdown and Great Recession of 2008 showed that Basel II underestimated the risks involved in current banking practices and that the financial system was overleveraged and undercapitalized, despite Basel II's requirements. Here are four key takeaways. 1. Basel II, the second of three Basel Accords, has three main tenets: minimum capital requirements, regulatory supervision, and market discipline. 2. Building on Basel I, Basel II provided guidelines for the calculation of minimum regulatory capital ratios and confirmed the requirement that banks maintain a capital reserve equal to at least 8% of their risk-weighted assets. 3. The second pillar of Basel II, regulatory supervision, provides a framework for national regulatory bodies to deal with systemic risk, liquidity risk, and legal risks, among others. 4. One weakness of Basel II emerged during the subprime mortgage meltdown and Great Recession of 2008 when it became clear that Basel II underestimated the risks involved in current banking practices and that the financial system was overleveraged and undercapitalized. Hope this would help. Thanks for watching.